Millions of everyday investors own these stocks right now thinking they are safe. The labels say blue chip, dividend king, value play, but the reality is far darker. Today we expose 7 companies that Wall Street analysts quietly avoid while publicly promoting. In 7th place, AMC Entertainment stands as the poster child for a retail-fueled zombie stock. Its debt load towers at nearly 4 times last year's revenue, roughly $4.4 billion in debt against $1.1 billion in revenue, leaving little room for error. Since the meme stock frenzy began in 2021, AMC's share count has exploded from 100 million to over 700 million, a staggering 600% dilution that gutted existing holders. While retail investors rallied behind the hold mantra, insiders quietly sold around $40 million in stock, filing Form 4 reports even as they urged faith in the company. With this cocktail of crushing leverage, runaway dilution, and insider exits, AMC's survival now depends less on profits than on the next wave of hype. The warning is clear: enthusiasm alone cannot pay the bills when the fundamentals are this broken. In 6th place, Nikola Corporation stands as a case study in governance failure and the catastrophic cost of unchecked hype. The company's founder was convicted of securities fraud, sentenced to 4 years in prison, and left the business saddled with a $30 million penalty from the SEC. Nikola's official filings reveal a staggering 17 material weaknesses in its internal controls, spanning revenue recognition, cash forecasting, and equity transactions, each one a red flag for financial misstatement. Promised products never made it to market, while the company's cash burn topped $175 million per quarter, leaving less than a year's runway before new funding is needed. Investors who trusted the narrative faced not just disappointment, but the hard reality of legal overhang, regulatory scrutiny, and a balance sheet riddled with unresolved risks. In the 5th place, Chinese American depository receipts, especially those using the variable interest entity structure, carry a risk that few retail investors truly grasp. When you buy shares in a company like DD Global, you are not actually buying ownership of the business itself. Instead, you hold a contract, one that can be revoked at any time by regulators in Beijing. This structure sidesteps Chinese law forbidding foreign ownership of sensitive sectors, but it leaves U.S. investors with no claim on the underlying assets. In 2021, DD's forced delisting from the NYSE came just 6 months after a $4.4 billion initial public offering, wiping out billions in shareholder value and leaving American holders with no recourse. More than 200 Chinese American depository receipts have been flagged by the SEC for audit non-compliance, appearing on a public list that signals heightened risk of delisting. The PCAOB still cannot inspect the audits of these companies, making the financial statements impossible to verify. The lesson is stark: contractual ownership can vanish overnight, and the flagged list from the SEC is a warning few heed. In 4th place, Altria Group carries the badge of a dividend king, 54 consecutive years of payouts, a name that anchors retirement portfolios and index funds alike. But behind the reassuring yield, the foundation is quietly eroding. Altria's 2024 annual report reveals a stark reality. Operating cash flow came in at $8.1 billion, while dividend commitments reached $8.5 billion. For the first time, the cash engine no longer covers the promise to shareholders, a warning light that many income investors miss until it is too late. The cracks run deeper. In 2023, Altria recorded a $13 billion impairment on its investment in Juul Labs, a single write-down that wiped out years of earnings and stands as one of the largest in consumer goods history. The company's own filings, specifically Note 7 in the 10K, lay out the scale of this misstep in black and white. Cigarette sales, Altria's core business, continue to slide, down 4% annually, as the customer base shrinks with each passing year. Regulatory threats loom overhead. The Food and Drug Administration's latest docket shows a proposed ban on menthol cigarettes, targeting the last major growth segment for Altria's traditional brands. If enacted, this single rule could erase billions in future revenue, compounding the pressure on both cash flow and dividend coverage. Despite the familiar narrative of safety and stability, Altria's numbers now tell a different story. The dividend, once untouchable, is increasingly funded by financial engineering rather than real operating strength. It is a stark reminder that even the most trusted income stocks can become a melting ice cube, shrinking quietly until only the label remains. Investors who rely on reputation alone risk waking up to a payout that simply cannot last. The warning is clear: do not let a long streak blind you to a business in slow motion decline. In the third place, Seagate Technology reveals how financial engineering can quietly turn shareholder rewards into a ticking time bomb. Over the past 3 years, Seagate spent nearly $15 billion on share repurchases, an amount nearly matched by its $30 billion in long-term debt. But this is not a case of spending excess profits. Instead, the company has borrowed aggressively to fund buybacks, pushing its net debt to EBITDA ratio to about 1.9 times. As interest rates climbed, Seagate's annual interest expense has tripled since 2022 and now threatens to swallow much of its free cash flow. The balance sheet tells a stark story. What looks like a generous return of capital is masking a mounting interest burden and growing credit risk. For investors lured by headlines about buybacks and capital returns, the real cost is buried in the footnotes. Debt-fueled support for the share price that leaves the company exposed if markets or rates turn. The warning is clear. When buybacks are funded by borrowing, the bill always comes due. In second place, a major ESG asset manager faces the kind of reckoning that shatters more than just a brand. In August 2023, German financial regulator BaFin raided the Frankfurt headquarters of DWS Group after a whistleblower leaked internal memos revealing that the firm had inflated the sustainability credentials of its investment products. The U.S. Securities and Exchange Commission had already opened its own investigation a year earlier, triggered by mounting evidence that ESG labels were being applied to funds with little or no genuine environmental oversight. The leaked documents, later authenticated by multiple news outlets, showed how portfolio managers were pressured to stretch the definition of sustainable to capture billions in ESG-driven inflows. But the real risk for investors goes beyond fines or headlines. Most ESG-focused exchange-traded funds and mutual funds are bound by strict prospectus language. If a holding loses its third-party ESG rating or becomes the subject of a formal regulatory probe, it is automatically excluded from the index. This means that once the DWS probe became public, passive funds were forced to dump shares regardless of price or fundamentals. The result is a cascade effect where a single downgrade or regulatory action can trigger a wave of selling across dozens of funds, amplifying losses for anyone left holding the stock. What began as clever marketing turned into a legal and reputational crisis, exposing the fragility behind the ESG label. For retail investors, the warning is unmistakable. When sustainability claims unravel, the sell-off is swift and the safety net is gone. And finally, in first place, Tesla stands as the most glaring warning sign on this list, a stock where optimism and risk collide on a scale few retail investors fully grasp. The numbers alone are enough to make even seasoned analysts pause. Tesla currently trades at a forward price-to-earnings multiple near 80, more than triple the S&P 500 average and far beyond the already inflated levels of the so-called Magnificent Seven. At these heights, the market is betting not just on growth, but on a future that borders on perfection. But beneath the surface, the foundation's shifting. Over the past 12 months, Tesla insiders have quietly unloaded close to $900 million of stock. These are not small, routine sales. They are systematic disposals by top executives and board members, filed on Form 4 and visible to anyone willing to look. While the public narrative celebrates innovation and disruption, those closest to the business are reducing their exposure at a historic pace. The story does not end with insider exits. Since 2021, Tesla has revised its accounting policies 3 times. Each change, whether in revenue recognition, the treatment of software development costs, or the valuation of stock-based compensation, has the effect of smoothing earnings or boosting reported profits just when market scrutiny intensifies. These maneuvers are disclosed in the footnotes of the 10-K but rarely discussed in the headlines. Analysts have called out this pattern as a form of earnings management, a red flag for anyone relying on reported numbers alone. Yet the most dangerous risk may lie in the stock's sheer systemic footprint. Tesla now sits in 47 major exchange-traded funds, with a combined exposure exceeding $200 billion. Index giants like Vanguard, BlackRock, and State Street are compelled to hold massive stakes not by choice but by the rules of passive investing. If a single major broker downgrades the stock or if earnings disappoint, these funds must rebalance, triggering a cascade of forced selling that can turn a routine correction into a rout. For retail investors, the danger is being the last to react, holding the bag as institutional money exits through automated trades. The warning signs are all here. A valuation bubble built on hope, insiders heading for the exits, flexible accounting that flatters the story, and a market structure primed for a domino effect. In the end, Tesla is not just a risky stock, it is a case study in how narrative can inflate risk far beyond what the numbers justify. For anyone tempted by the headlines, the lesson is clear. When the crowd is all in and the insiders are quietly leaving, it pays to look twice before you follow. Across all 7 stocks, one pattern cuts through the hype. Familiar labels can mask excessive debt, insider selling, fraud, toxic dilution, greenwashing, and valuation bubbles, while Wall Street quietly steps aside. These are not isolated outliers, they are warning signs repeating in plain sight. Always do your own research. Subscribe for more investigations.